Hello everyone. In this video, I am going to explain you about financial derivatives and risk management. It is a comprehensive analysis of financial derivatives, how these will be useful to mitigate the risk. Right. First and foremost, in this video, I am going to explain you about the financial derivatives like forwards, futures, options, and swaps. Right. Before we go further, I would like to inform you what is the risk management. Risk can be defined as a deviation of the actual results from the expected. If I am expecting rate of return 20%, if I get 18%, so there is a risk involvement is there. So again, I'm going to tell you, whenever you are expecting 20%, if it is more than the 20%, then will also be the risk involvement in this. Means it could be higher or it could be lower. So risk can be classified in two ways: risk of small losses with high probability, like stock prices, exchange rates, and commodity prices. In other words, risk of large losses with low probability, like theft, earthquake, tsunami, etc. In financial terms, risk can also be divided into two types, like systematic risk and unsystematic risk. Systematic risks like inflation risk, interest rate risk, and market risk. These are we can't diversify with other securities. Whereas unsystematic risk, it can be diversified. It could be financial risk or operating risk. Both the risks we can diversify with other securities. Right. Having said that, let me go for the derivatives are used to manage the risk that originate from normal operations of the business. Risk of small losses with high probability. So, management is of risk through derivatives is commonly referred as hedging. Hedging is also known as a risk management technique. So, what do you mean by hedging? I will go further. Right. Before that, overview of the derivative contracts. Basically, derivatives or the contracts, the value of the derivative is derived from the price of underlying assets. The common examples of underlying assets are stocks, bonds, commodities, interest rates, and market indexes. Again, I'm going to tell you that derivative is a financial instrument or a contract whose value depends on the derived from the value of some other financial instrument, that is called underlying asset. So people are using, whenever we call it as a derivative, means it is a price of underlying asset. So in brief, understanding about underlying asset means the financial state instrument whose value depends on and derived from the value of some other financial instrument, that is called underlying asset. The basic and common examples of underlying assets are stocks, bonds, commodities, currencies, interest rates, and market indexes. Again, the main purpose of derivative is to transfer risk from one person or firm to another person or another firm. Right. Derivatives derive their names from the respective underlying asset. So the derivative underlying asset is equity basically. Whenever there is a derivative underlying asset is the equity, then it will be called as a equity derivative and so on. If it is a commodity, commodity derivative, currency, currency derivative, interest rate derivative, like that. So then again, I'm going to tell you it is just like transfer of risk from one party to another. If doing so, derivatives help mitigate the risk arising from the future uncertainty of prices. For example, if November 1, 2018, a rice farmer he wants to wish sell is always at a future date in January 2009 for a predetermined fixed price to eliminate the risk of change in prices by that date. So here the price of this derivative is derived by the spot price of the rice which is underlying in that. So then what are the types of derivatives? Right. Classification based on the product. It is a forwards, futures, options and swaps. Either classification based on the underlying asset, equity derivatives, index derivatives, commodity derivatives, currency derivatives, interest rate derivatives, and weather derivatives. Because sometimes rainfall may affect the derivative concept as well. Then classification based on the trading over the counter contracts and exchange traded contracts. Right. Then, so how it has been origined. The main advent of modern day derivatives contract is attributed to the formers. Earliest evidence of trading is traded back to ancient Greece. The first futures contract can be traced to the Yodaya rice market in Osaka, Japan, around 1650, which later evolved into the Dojima Rice Exchange. In 1848, the Chicago Board of Trade was established to facilitate trading of all the forward contracts and various commodities as well. Then, in India, derivatives market have been functioning since 19th century with organized trading in cotton through the establishment of the Cotton Trade Association in 1875. Then, derivatives exchange traded financial instrument is introduced in India June 2000, recently, 20 years back. The National Stock Exchange is the largest exchange in India is in derivatives, trading various derivatives contracts. The first contract launched on NSE was the Nifty 50 Index Futures contract. Right. Nifty 50. Right. Futures index future contract. In a span of 1.5 years after the introduction of the index futures, index options came into the picture, and stock options and stock futures are came into the surface. But also they are also introduced in the derivative segment of trading. Right. NSE equity derivative segment is called future and option segment of FNO. Futures and options segment. So NSE also traded in currency and interest rates future contracts under separate segment. Now, let me move on to the derivatives one by one. First and foremost, I will go for the forwards. What do you mean by forwards? A forward contract is a customized contract between two entities where settlement takes place on specific date in the future at today's pre-agreed price. In other words, it is a contract between two parties to buy or sell an asset at certain future date for certain price, but the price will be determined by now itself only predetermined price or pre-agreed price on the date of the contract. If you wanted to buy or sell, you have to pay that much amount, the price which is agreed at now, means the pre-agreed price. Right. Again, the future date is referred as a expiry date when you are going to payment settlement will be done. And the pre-decided price is referred to as a forward price. Please understand carefully about all these terminologies in the derivatives. The expiry date is nothing but future date is referred. And forward pays at pre-agreed price as of now what you have agreed now itself. The party agrees to buy an asset on future date is long. Investor is position as a long position. Long means agrees to buy. The long position is nothing but buying position. Similarly, the parties agrees to sell asset in a future date is referred to as a short. Investor is said to have a short position. Short means sell, long means buy. Understand that and remember that also. The forward contracts are traded only in the over the counter market and not in the stock exchanges. Therefore, it is subject to the market risk. Again, then coming back to the futures. Unlike forward contract, futures contract is an agreement between two parties, and this is not a private transaction but gets traded on recognized stock exchange. There is a difference between forwards and futures. Forward is a customized contract. It is not traded on the recognized stock exchange. The forward is as traded in the over the counter exchange only. It is not in the position of recognized stock exchange. Whereas futures, it is a contract. It will be traded on recognized stock exchange. In addition to that, a future contract is standardized by the exchange. All the terms of the contract are set by the stock exchange itself. Again, it is a protected against counterparty risk or default risk by any entity called, that is called clearing corporation, will clear the settlements to be able to guarantee the fulfillment of obligations under the contract. The clearing corporation holds some amount of security from both the parties. That amount is called margin money. In our terminology, whenever we are giving any rent or anything, we are taking some money that is known as a token money. Similarly, in the futures, if for the purpose of guarantee the fulfillment of the obligations under the contract, the clearing corporation holds some amount as a security from both the parties like buyer and seller. That amount is called margin money. Right. Having said that, since the future contracts are traded in the stock exchanges, the parties have the flexibility of closing out the contract prior to the maturity by squaring of the transactions in the market. Right. They can also close before the expiry date as well. Right. Then go for the options. An option is also derivative contract between buyer and seller, where one party gives the right but not obligation to fulfill the contract. Here you need to understand the word very carefully, that is right but not obligation. Right. Whereas in return for granting the option, the party granting the option called collects a payment from other party, that is called premium. Similarly, while we are taking the token money, margin money, similarly in the options we are using the word premium. The payment collected from one party to other party, the option collects a payment from other party. That amount is known as premium or price of the option. The right to buy or sell is held by the option buyer, also called option holder. The party granting the right is the option seller, also known as option writer. So, option seller is the party granting the right. Option buyer, the party right to buy or sell, held by the option buyer. Option holder means right to buy or sell the particular product. The option seller is also known as option writer. Buyer has the right but not obligation to fulfill his contractual obligation. Seller has an obligation to fulfill his contractual obligation. Right. Then moving on to the swaps. Right. Swap is means the derivative contract which two parties exchange the cash flows from two different financial instruments. Swaps are private agreements between two parties to exchange cash flows in the future according to the pre-arranged formula. They can be regarded as a portfolios of forward contract. The most common kind of swap is interest rate and currency swaps. They can swap, they can exchange their cash flows either in the interest rates or in the currencies. Again, I'm going to tell you, swaps don't trade on exchanges and retail investors don't generally engage in swaps. Rather, swaps are the over-the-counter contracts as like forward contracts, primarily between businesses or financial institutions that are customized to the needs of the both the parties. Then I am moving on to the some terminologies of the derivatives which are very important to understand the risk management and derivatives. First and foremost is a spot price. It is the price that is quoted for immediate delivery of the asset. Means whenever you are going to make buying or selling, what is the price you are quoted for immediate delivery, that is called spot price. Right. forwards price or future price. The price is agreed upon the date of the contract. After some time, how much you are going to pay, how much you are going to make settlement, that price is known as forward price, right? Strike price, the price at which stock will be brought or sold when the option is exercised. So the strike price is only used whenever there is an option. Strike price is used in the case of options only, not on the basis of futures or forwards. Again, spot price, delivery. For immediate delivery, how much your price is quoted, that is called spot price. Forward, at the time of expiry, pre-agreed price, that is a specific future date, that is called forward price. Strike price, the price which stock will be bought or sold when the option is exercised. Whenever your option is exercised, that is called strike price. So strike price will be used only for the options, not for the futures or forwards. Then expiration date, the date on which final settlement takes place. European options, or that can be exercised only on the expiration date. They can't exercised before the expiration date. American options, they can option that can be exercised any day on or before the expiry date. Then contract size, one contract derivatives instrument represents certain number of shares of the underlying asset. Then what is the significance of derivatives? What are the importance of derivatives in present situation? Right. So the 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 main thing we can identify about the derivatives is the risk management. Means there are several risks inherent in the financial transactions. So the main advantage is the derivatives can mitigate the risk, the reduce the risk. Derivatives are used to separate risk from the traditional instruments and transfer these risks to the parties willing to bear these risks. The fundamental risks involved in derivatives are credit risk and market risk. Again, second advantage or importance is enhance liquidity of the underlying assets. So they can, the liquidity means how fast you can convert into the cash. So the derivatives can enhance the liquidity as and when you needed money, you can go for it, and with pre-agreed price. Then aids price discovery. They can easily identify the price discovery in future. Improves market efficiency, provides signals for market movement. Even intraday traders get the benefit of liquidity as these contracts are very liquid, and also the cost such as the base of the expense, and even brokerage is also less compared to the cash market. And better portfolio management catalyze the entrepreneurship skills. See, and it is also provide the management of the risk efficiency in the trading. The financial derivatives allow for free trading of risk components, and that leads to the improving market efficiency. And as usual, this is not only used in the speculation, probably not the most important use in the financial derivatives are considered to be risky. If they are used, if it is not used properly, the financial derivatives will be more risky. But if it is used properly, it can lead to the financial benefit because of the financial transactions, right? Price discovery, as I mentioned, the price discovery which means revealing the information about the future cash market prices through the future market. Derivative markets provide a mechanism by which diverse and scattered options of future are collected in one readily number, which the provides consensus of knowledge of the thinking. So the price discovery means revealing information about the future cash market prices through the futures market. And there are so many other benefits are also there, like it will provide the derivatives takes place in future, it provides individual better opportunities in that. And in derivative market, people can transact huge transactions with small amounts. Therefore it gives the benefit of leverage, and hence even people have less amount of money can enter into this market. See, these are the different advantages and importance of the derivatives. Then identifying the risk exposure means the measure of possible future loss which may result from an activity or occurrence. Basically, in business, the risk exposure is often used to rank the probability of different types of losses. The business risks or threats, if not addressed, can significantly stress the business or even cause it fail. So, business risk also include weather risk, foreign exchange risk, regulatory or mechanism, or economic environment risk. It's business risk again vary from industry to industry. It is differ from one company to another company. Right. Again, measurement of risk. Random variable method. Quantification of risk is a fundamental to almost all the commercial transactions which may be taken about an enterprise. So this is called VAR, value at risk. Considers both the statistical probability that the certain conditions will occur and multiply the resulting likely number against the maximum loss possible. Right. Then past data method depend on the past data. If company had measured this loss in the past, historical data can also use it to identify the risk as well. Right. Then accounting for derivatives, accounting standard 30 issued by ICAI prescribes the accounting treatment for the derivatives. This is again the futurity, origination and investment will be defined in the accounting standard 30. In either case, they would be market to market or on each reporting date. That is called MTM, market to market on exchange reporting date. So, if held for trading, MTM gains or losses would be recognized in the profit and loss account. If the form part of the edge, the mark to market item would be clubbed with the edged item. Then what is the again? I am going for the one by one in clear cut manner. Comprehensive analysis about the forward contract, then again future, then again options and swaps. First and foremost, the first forward contract, it is an agreement between two parties, which one party, the buyer, enter into agreement with other party. The seller would buy from the seller on underlying asset on expiration date at the forward price. So, forward contract are traded only in the over the counter exchange. The settlement. There are two types of settlement, physical settlement and cash settlement. Both types of settlement happen on the expiry date. Physical settlement, again, I'm going to tell short investor means seller, long investor means buyer. So, physical settlement, if you don't, at the time of the expiry date, if you don't have the concerned stock, you have to buy in the open market and give it to the concerned buyer. So, that is the closing price of any given day is a weighted average price of the underlying the last half an hour of the trading that day. So again, the physical settlement, if it's suppose 29th August 2000 expiry date, A has to actually deliver 1000 Unitex shares to the B and B has to pay price to A. In case A doesn't have, again I'm repeating, in case A doesn't have, because it has happened in the future date, future price, future agreement. In case it doesn't have 1000 shares to deliver on 29th August 2000, he has to purchase it from the spot market or open market and deliver to the stocks B. Right. The cash settlement, it doesn't require any physical settlement. So the main disadvantage of the physical settlement is it results in the huge transaction costs in terms of actual purchase of securities by the party holding the short position and transfer of the security to B in the long position. But an alternative way of settlement with physical settlement, which helps in minimizing the cost, that is called cash settlement. If the party long position is actually not interested in the holding the security, then she uh, will have to incur further transaction costs in disposing of the security in the physical settlement. Whereas in cash settlement doesn't involve actual delivery of the receipt of the security. What exactly it will happen in the cash settlement? Because each party either pays cash equal to the net loss or profit arising out of the respective position in the contract. If the spot price at the expiry date was greater than the forward price, The party with the short position will have to pay an amount equivalent to the net loss to the party of the long position. Right. Depending on the closing price, there are three different scenarios. First is, if spot price is greater than the forward price, the party who has long position would make a profit. If spot price is less than the forward price, the party who has short position would make the profit. If it is equal, neither party will gain or lose anything. Then, default risk in forward contracts, as it is basically traded in the over the counter exchange, there is always the default risk. Regardless of whether the contract for physical or cash settlement, there exists a potential for one party to default, not honor the contract. It could be either the buyer or seller. That results the other party suffering loss. The risk of making loss due to of any two parties defaulting is known as counterparty risk. The main reason behind such risk is absence of any mediator between the parties who could have undertaken the task of ensuring the both the parties. Default risk is also called credit risk or counterparty risk. So there are two differences. I mean, difference between forwards and future. It will be traded on the over the counter exchange. It is but organized commodity exchange, organized stock exchange, or organized commodity exchange. Liquidity, there is not much liquidity in the forwards, but high liquidity in the futures. Default risk is very high in the few forwards because it will be traded in the over the counter exchange, and the credit risk and default risk, our counterparty risk, will be very high in the forwards, whereas in the futures almost no. Margin not required, it is required. Regulation, self-regulated by stock exchange, will be regulated. Maturity as per the terms of the contract, mark to mark on daily basis and expires on the last Thursday of the month. Settlement dates can be set by the parties. Fixed settlement dates as declared by the exchange. Then trading futures, it will be called as a long payoff or short payoff. If it is a long payoff, means spot price minus future price. Short payoff means future price minus spot price. The payoff, the future contracts, basically maturity depends on the spot price of the underlying asset at the time of maturity and the price which the contract was initially traded. Again, it is also, even in the futures also, there will be long position and short position. Long means buy, short means sell. Right. Long payoff, spot price exceeds the future price. Short payoff, future price exceeds the spot price. These are the different things. Price at maturity will be like this, long payoff will be like this, and short payoff will be like this. Then theoretical model is for future pricing, it will be the spot price, and the formula will be there, the spot price of the underlying asset, cost of financing, time till expiration in a years. E will be there, E means 2.71828. This is the thing. See, this model is also called cost of carry model of the pricing futures. Every time the market price of the futures deviates from the fair value determined by using this formula, arbitrageurs enter into trades to capture the arbitrage profit. For example, if the market price of the future is higher than the fair value, the arbitrager means would sell the future market and buy in the spot market simultaneously and holds both the trades till expiry and book riskless profit. As more and more people do this, the future price will come down to its fair value level. The thumb rule in any sort of spread trade is to buy cheaper asset and sell the expensive one. That is a thumb rule. There again, participants in the derivatives market. See here, there are three types of participants are there in the derivatives contract. As equity markets evolved, different categories of investors started participating in the market. Right. So in India, equity market participants currently include retail investors, corporate investors, mutual funds, banks, foreign institutional investors, etc. Each of these investors categorizes what you call the different types of risk management techniques and investment strategies are speculation activities. Based on the applications that derivatives are put into, these investors broadly classified into three groups. Those are the hedgers, speculators, and arbitrageurs. So, what do you mean by the hedgers? Basically, Please understand carefully the edges. These are investors have the position in the underlying market but are worried about the potential loss arising out of change in the asset price in the future. Hedgers participate in the derivatives market to lock the prices at which they will be able to transact in the future. They try to avoid price risk through holding position in the derivatives market. A hedger normally takes an opposite position in the derivatives market to what he has in the underlying market. Hedging includes all the activities aimed to reduce uncertainty about the future price movements in a commodity or financial security or foreign currency. This can be done by the undertaking forward or future sales or purchases of the particular commodity or security or currency in the over the counter forward or the organized futures market. Alternatively, it just can take out an option which limits the holder's exposure to price fluctuations. This is called hedges. They can go for the either short hedge or long hedge. Again, short hedge involves taking short position in the futures market. Short hedge position is taken by someone who already owns the underlying asset or is expecting future result of the underlying asset. For example, investor holding the Reliance shares may be worried about the adverse future price movements and may want to hedge the price risk. He can do so by holding short position in the derivatives market. The investors go short Reliance futures at National Stock Exchange. This protects him from the price movements in the Reliance stocks. In case the price of Reliance share falls, the investor will lose money in the shares but will make up this loss by gain made in the Reliance futures. This is what they will do in the shortage. While coming to the long edge, means buying. The long position holder agrees to buy underlying asset at the expiry date by paying the agreed future price or forward price. This strategy used by those who will need to acquire the underlying asset in the future. For example, a chocolate manufacturer who needs acquired sugar in the future will be worried about any loss that may arise if the price of sugar increase in the future. To hedge that risk, the chocolate manufacturer can hold long position in the sugar futures. If the price of sugar rises, the chocolate manufacturer may have to pay more to acquire sugar in the normal market, but he will compensate against this loss through by profiting the taking the sugar futures. Right. Then coming back to the second participant in the derivative market is speculators. Means the person who is bets on the derivatives based on his views on the potential movement of the underlying stock price. Right. Speculators take large calculated risk as they trade based on the anticipated future price movements. They hope to make quick, large gains, but may not always be successful. The speculation involves betting on the movement of the markets and tries to take the advantage of the high gearing that derivative contracts offer, thus making windfall profits. In general, speculation is a common in markets that exhibit substantial fluctuations over time. Normally, speculator would take bullish or bearish view on the market and engage in derivatives that will earn profit if this view materializes in future. The normally shorter holding time for their positions as compared to the edges. If the price of underlying moves as per their expectations, they can make large profits. However, if the price moves in the opposite direction of the assessment, the loss can be also be enormous. Right. Then arbitragers. They lock riskless profits by taking positions in two or more markets. In simple way, what we can tell that if the price is less in one market and more in another market of the same commodity or same product, they will take and they will purchase which is having less in the one market and sell it in the another market with high price. This is what you call arbitragers. So they simply sell that they log riskless profits by taking positions in two or more markets. Arbitragers attempt to profit from pricing inefficiency in the market by making simultaneous trade that offset each other and capture a risk-free profit. An arbitrage may also seek to make profit in case there is a price discrepancy between the stock price and the cash and derivatives market. Then, stock index futures. It is a composition select securities traded on the exchange. Sensex is a composition of top 30 blue chip securities being traded on the BSE. Nifty is a composition of top 50 blue chip companies traded in the NSE. These are called stock index future. Therefore, stock index future contract is a simply a contract where the underlying variable is stock index, such as either BSE Sensex or NSE Nifty. Features: market lot size. The stock index futures can be bought or sold only in the specified lot size 50, 100, 200, like that. There will be lot size is there. Margin requirement and mark to the market. The traders in the stock index futures market are required to keep good faith deposits which are adjusted on daily basis to on account of the either gain or loss. Again, cash settlement. A stock index future contract does not entitle physical delivery of the stocks and the contract settled on the cash settlement on that particular. This is because it is virtually impossible to deliver all the stocks comprising the stock index that to same proportion which they appear in the index at the time of the settlement. So then, underlying instrument, it is a Nifty or Sensex. Trading cycle: Nifty 50 future contracts have a maximum 3-month trading cycle, then near month 1, next month 2, and the for month 3. A new contract is introduced in the trading day following the expiry of the near month contract. The new contract will be introduced for 3-month duration. Expiry day: Nifty 50 future contracts expire on the last Thursday of the expiry month. If it is a trading holiday, next day. Then, if trading is holiday, the contracts expire on the previous trading day. Right. Forward rate agreements. It is a hedging technique for interest rate risks. Uncertainty regarding future rates of interest is a matter of concern for both the potential borrowers as well as the lenders. The borrower would be worried about the rising rates, while lender will be concerned about the possibility of rate decline. Consequently, both the kinds of traders may wish to hedge the risk regarding future rates of interest. One such hedging tool is forward rate agreement. So it is a hedging techniques for interest rate risk. By using such derivatives, one can lock in a rate of interest for transaction schedule which will be happened in the future date. The rate of interest for forward rate agreement is termed as the contract rate. The party who agrees to pay this rate is known as the buyer of the forward rate agreement or the long, while the counterparty is known as the seller of the FRA, that is also short. In actual rate of interest after some months is higher than the contract rate, the long will receive payment from the short. If the rate were to be lower, the long would have to make payment to the short. Every forward rate agreement has specified participant principal amount that termed as a notional principal amount. Again, exchanging the differential cash flows, contracted interest rate, and the actual benchmark on the notional principal amount. This is the formula about the forward rate agreement. Then, example I have given here. Then how they are going to make the payment in the future. Forward rate agreement, if it is a rate settlement 7% against the 6.5%, one person is getting loss and another person is getting profit out of it. If the settlement rates is 6% against the forward rate contract is 6.5%, the Expo Limited would borrow 6% and would pay 0.5% more to Exim Bank in that. Then go back to the treasury bill futures. Having said that, forward rate agreements, then I will move on to the treasury bill futures. Treasury bills are the short term borrowing instruments of the government of India which enable investors to park their short term surplus funds while reducing their market risk. T bills, also known as treasury bills, issued on discount to the face value, which while the holder gets face value on maturity. Means normally treasury bills will be matured on the face value. Then what is the, you may ask, what is the benefit out of it? Means the treasury bills are issued on the discount. If it is 100 rupees, they will it is issued at discount at 80 rupees, but at the time of the maturity you are going to get 100 rupees. That is a on maturity price. The bill market, submarket of the money market in India. There are two types of bills: treasury bills and commercial bills. While treasury bills are issued by the central government, commercial bills issued by the financial institutions. In India, trading T-bill or treasury bill futures began in 2011. Most banks, financial institutions, and other treasuries invest in debt instruments like treasury bills. They trade in interest rates, T-bill futures to hedge themselves against the changing future interest rate movements in the future. The trading hours 9 a.m. to 5 p.m. on all working days from Monday to Friday, and the contract size is 2 lakhs minimum. The expiry or last day trading day final settlement day of the contract would be the last Wednesday of the expiry month. If any expiry date is trading holiday, then the expiry settlement would be previous trading day as usual. Then euro dollar futures. The term euro dollar refers to the US dollar denominated deposits in the foreign banks or the overseas branches of the American banks. Because they are held outside the United States, euro dollars are not subject to the regulation by the Federal Reserve Board. More generally, euro prefix can be used to indicate any currency held in a country where it is not the official currency. Yuan and euro. Euro. The euro dollar futures contract is one of the largest and most successful interest rate based contracts. So, if one have US dollar market exposure, euro dollar futures can help manage their risk. The euro dollar is contracted in 1881 by Chicago Mercantile Exchange, making first cash settled futures contract. Whereas the underlying instrument in euro dollar futures is euro dollar time deposit having principal value of 1 million with 3-month maturity. Then options. So, what do you mean by option? Is an option is also derivative contract between the buyer and seller. Here, one party gives the other the right but not obligation to fulfill the contract. In return granting of the option, the party granting collects payment from other party, that is called premium. Right to buy, sell, the option buyer is the option holder, option seller is the option writer. Buyer has the right but not obligation. Seller has an obligation to fulfill the contract. There are two types of options: call options and put options. What do you mean by call option? It is an option agreement, right? The buyer of the option to buy an underlying asset on specific day at agreed upon price but not the obligation to do so. If the seller who grants the right to buyer the option, the price which the buyer has the right to buy the asset at agreed upon at the time of entering into the contract, that price is known as the strike price of the contract. Since the buyer of the call option has the right to buy underlying asset, he will exercise right to buy underlying asset if and only if the price of the underlying asset in the market is more than the strike price on or before the expiry date of the contract. The buyer of the call option does not have an obligation to buy if he does not want to do that. Put option. Right. Here, the person who has the right to sell of the underlying asset is known as the buyer of the put option. The price at which buyer has the right to sell the asset is agreed upon at the time of the entering contract. This price is known as the strike price of the contract. Since the buyer of the put option has the right to sell the underlying asset, he will exercise his right to sell the underlying asset if and only if the price of the underlying asset in market is less than the strike price on or before the expiration of the contract. The buyer of the put option does not have the obligation to sell if he does not want to do that. Right. Then the difference between futures and option, both the buyer and seller under the obligation to fulfill the contract. The buyer of the option is a right but not obligation of the seller of the, whereas seller is under obligation to fulfill the contract. In case of futures, the buyer and the seller are subject to unlimited risk of loss. In case of options, the seller is subject to unlimited risk of losing, whereas the buyer has a limited potential to lose. Again, futures, in case of futures, the buyer and seller have potential to make unlimited gain. In case of options, the buyer has a potential to make unlimited gain while the seller has a potential to make limited gain. Then, option terminologies. Again, I'm going to tell you the price at which the buyer of an option can buy the stock or sell the stock on or before expiration of that contract is called strike price. Option premium is collecting some amount if the income received by the seller or writer of an option of the contract. An option premium will be called, this is also referred to the current price on specific option of the contract that had to expire. European options exercised only on the expiration date. American on a any day on or before the expiration date they can exercise. This is long and this is short. This is the put options, long or short. The moneyness of the on option means it is indicates that whether an option is worth exercising or not. Means if the option is exercised by the buyer of the option, whether he will receive money or not. Moneyness of an option at any given time depends on where the spot price of the underlying is that point of time relative to the strike price. The premium paid is not taken into consideration while calculating moneyness of the option, since the premium once paid is sunk cost. You can't repeat it back. Here, the three: in the money, out the money, and at the money option. See here, in the money option, in the money means exercising option, it would produce cash flows for the buyer. The call options are in the money when the value of spot price of the underlying exceeds the strike price. On the other hand, put options are in the money when the spot price of the underlying is lower than the stock strike price. Right. Moneyness of the option should not be confused with the profit and loss arising from holding of an option contract. It should be noted that while moneyness of an option does not depend on the premium paid, profit or loss do. Thus, a holder in the money option need not always make profit, as the profitability also depends on the premium paid. Out of the money option is opposite to the in the money option. An option holder will not exercise the option when it is out of the money. A call option is out of the money when the strike price is greater than the spot price of the underlying. Put option is out of the money when the spot price of the underlying is greater than the option strike price. At the money option. At the money option is one which spot price of the underlying is equal to strike price. It is stays where with any movement in the spot price of the underlying, the option will either be coming in the money or out the money. It may be noted that an option which is in the money at a particular insurance instance that may turn into the out of the money at another instant due to change in the price of the underlying asset. Here, the profit or loss calculations, if it is a long call, maximum spot price, strike price, then premium per share. Short call, premium per share minus maximum either spot price or strike price. Long put, maximum of strike price or spot price and premium per share. Short put, premium per share minus maximum stock price and spot price. Then components of the option premium. Here, intrinsic value and time value. The intrinsic value difference between the underlying spot price and the strike price to the extent that this is in favor of the option holder. Whereas time value, the option premium is always greater than the intrinsic value. This extra money for that risk is which the option writer or seller is undertaking. This is called time value. Again, intrinsic value, call option, current stock price minus strike price. Put option, strike price minus current stock price. Time value, option premium minus intrinsic value. Factors affecting premium is first one, underlying price of the asset, strike price of the asset, and volatility, future changes in the uncertainty about future changes in the price of the underlying asset, time to expiry, and securities dividend and current risk free rate of interest rate. All are the options premium factors choose. Then Greeks. Again, for option trader, assessing the variation premium is most important. First is delta, gamma, vega, theta. Delta means changes of the option premium based on the directional movement of the underlying, that is called measured by the delta. Gamma, how much rate of change is in delta is known as the gamma. Vega, it is a change of premium based on the change in volatility is vega. Theta, measures of the impact of premium based on the time left for expiry is theta. Again, delta of call options, delta of put options, and gamma means the rate of change of the delta is known as the gamma. Then all these are there, even theta and gamma. Then go back to the swaps. See, the swaps is a financial instrument came into the existence due to the presence of the exchange controls and restricted in the movement of capital from one country to another. The amends operating in various countries could not freely remit funds back and forth among their subsidiaries due to the exchange controls exercised by various governments on capital flows. They came out with the innovation of back-to-back parallel loans among themselves. The swap is a it is also a derivative contract which two parties exchange the cash flows or liabilities from two different financial instruments. Then again, swaps are there: interest rate swap and currency swap. Interest rate swaps provide a way for business to hedge their exposure to changes in the interest rates. Interest rate swap is an agreement between two parties to exchange one stream of interest payment for another over the period of time. The most common type of interest rate swap is a vanilla swaps, which a party A agrees to make payments to party B based on the fixed interest rate, and party B agrees to make payments to party A based on the floating interest rates. The floating rate is tied to reference rate that is called a London interbank offer rate. Example, if it is a assume that Ram owns 10 lakhs investment that pays with him MIBOR, Mumbai Interbank offer rate plus 1% every month. As MIBOR goes ups and down, the payment Ram receives changes. Assume that Sham owns 10 lakhs invest that pays him 1.5% every month. The payment he receives never changes. Ram decides that he would rather lock in constant payment, and Sham decides to he would rather take chance of receiving higher payments. So they can exchange their interest rates and they can go either one person is going to get profit and another is going to get loss. Then coming back to the currency swaps. The purpose of engaging in currency swap is usually procure loans in foreign currency at a more favorable and affordable interest rates than if borrowing directly in a foreign market or hedge exposure to risk. It is a similar to interest rates except that is a currency swap. This is there is often an exchange of principal, whereas in interest rate swap principal does not change hands. A foreign currency swap is an agreement to exchange current currency between two foreign parties in which they swap principal and interest payments of loan made one currency for loan of equal value of in another currency. There are two main types of currency swaps: fixed to fixed currency swaps and fixed to floating swaps. And I have given example here. And equity index swaps are also there. In an equity swap deal, one party agrees to pay the return on notional principals to another party, who in turn agrees to pay fixed or fluctuating rate of interest on the notional principal amount. I have given example in this. And credit swap is also there. Credits default swap is like insurance policy wherein debt holder pays periodic amount to the other party. In case of happening of the credit event, other party compensates the former for the loss. The credit must be specified in the credit default swap agreement. Event by delay or non-payment of interest, delay or non-payment of the loan amount, etc. In case of physically settled claims, the protection buyer would return the security of the reference entity. In case of cash settled claims, the default obligation of the reference entity is valued and would be paid by the protection seller to the protection buyer. Here I have given example. Again, exotic options. It is an option which has features making it more complex than commonly traded vanilla options. They differ from traditional options in the payment structure, expiration dates, and strike prices. They usually trade in the over-the-counter market, dealer broker network as opposed to large exchanges such as the New York Stock Exchange. They have payoffs that are more complicated than payoffs in general options. One primary reason for the popularity exit option is the reduction in premium for the buyer. Types of exit chooser options, binary options, and Asian options, and extendable options, and leaps, long term and equity anticipation securities. Basically, they were created for investors who wanted to create long term strategies. Normally, options have maturity period up to 3 months, but leaps have maturity period even extending up to 3 years. Leaps are available in the both the calls and puts. And short options, it locks at an amount in a profit while retaining future upside potential in the position. And compound options that give owner the right but not obligation to buy another option at a specific price or specific day. Typically, underlying asset of traditional call or put option is an equity security. However, underlying asset of compound option is another option. Compound options in four types: call on put on put on call, and barriers options. similar to the like plain vanilla calls puts, and but only become activated or extinguished when the underlying asset its preset price level. The best example of barrier options is, let's say barrier option has a knockout price of 100 rupees, strike price is 90, and the stock is currently trading at 80 price. The option will behave like standard option when the underlying below 99, but once the underlying stock price hits 100, the option gets knocked out and becomes worthless. This knock-in would be the opposite. If the underlying below 99, the option does not exist. These are the different types of options. Thank you. Thank you, one and all. Thank you for supporting me. Thank you for encouraging. Thank you. Have a nice day.